This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So it's a solemn week for us value investors because Warren Buffett has put out a Thanksgiving letter and revealed, as we already knew, that he would not be speaking at next year's Berkshire Hathaway annual meeting, and he will no longer do the annual letter for Berkshire Hathaway. But he is going to continue with these Thanksgiving letters, apparently. So he said he was going quiet, but he's not going to be totally quiet, apparently. But this is all to be expected from the world's greatest investor, who is now 95 years old. He is deserving of, moving away from the spotlight if he wants to. And we will continue to just learn from some of his investing lessons. And there's plenty of years of content we can refer to for ideas and for support when we start to get shaky about our own value investing capabilities. And right now it is a little bit of a shaky time because growth is really back in the spotlight. And a lot of the areas where the value stocks are in the unfavorable areas. A lot are in energy. Berkshire Hathaway owns a bunch of those. A lot are in old economy type stocks like chemicals and even, home builders and those kinds of industries. Then he's in, or he's not in the AI story as much, although it is a little bit easier to get into the AI trade now as a value investor because some of it does involve the old economy, especially on the electrical, construction, power generation side. And so I'm sure Berkshire Hathaway has a little bit of exposure to it, even if we don't think it does. It does own several companies that are big in manufacturing and all of the energy types of components and things. So I bet they do have a little bit more exposure to it, but it's still a little bit more difficult for value investors right here. But I thought this week on the show, in honor of Warren Buffett and his stepping aside, although we're going to have more of these shows as we go on through the end of this year when he officially will take leave from Berkshire Hathaway. But I thought I would look for 3 value stocks that are, Buffett type stocks. And what does that even mean? It means it's going to be a cheap stock. I'm looking for the classic type of value. So low price to book, low price to sales, low price to cash flow, low PEG, low PE. And then I'm going to throw the Zacks rank on there. So I did run the classic value stocks with number 1s and number 2 ranks to see what I got. But we also know Buffett likes to buy companies that have moats that are in some of these kind of old economy industries, because if they're old economy, they've made it this far. They've survived. And that means they have some kind of edge if they're still in business, 50, 60, 70 years later. And that's the moat aspect of it. He loves buying companies with that. He loves companies that have the good free cash flow. And so I ran the screen hoping I would get some of these stocks, and then I did. So running that screen, again, it has price to book under 2, which is very cheap. I usually look for 3 or less. Price to sales under 1. That's what we always look for because we want to get those sales cheaper. We want to get them at 70 cents for $1 worth of sales. Price to cash flow is under 20. PEG is under 1. PEG is just going to combine the PE with the growth. And the PEG ratio is, was started, or at least initially adopted, by Benjamin Graham, Warren Buffett's own mentor, who is one of the greatest, or was one of the greatest value investors of all time as well. So we're going to adopt his PEG ratio of 1 or less. That'll give us growth and value, hopefully. PE, and this one is a little bit higher because we've got all these components, and it would just be too tight if we went for 10 or 15. So it looks for under 20. And then we want it to be $5 or more, because I don't want to deal with, a dollar stock or $2 stocks. And then we're using Zach's ranks of number ones and number twos, the strong buys and the buys. And it throws on the style score for value of A's or B's. Those are the top 2 style scores. But the style scores are mostly going to include all of the classic value fundamentals I just said. So a lot of valueness in this. Now, over the years, when we've run this screen, and we have run it every year for, I don't know how long now, 8 years, 9 years. It's been a long time. We've been doing this podcast. But we've never gotten less than the 5 stocks. And I was curious, given that the stock market is busting out to new highs, the valuations are a little stretched here once again, whether or not we would get those 5 or maybe even less, because again, you have to have that rank in there too. But this time running the screen, we did get 9 stocks, 9. So that was better than I thought. And 2 are Zach's number 1 ranks. And then we had 7 that are the number 2s. On the value score, all 9 are value scores of A. So that's interesting. We had no B's on this one. Let me just look real quick at just the PEs. The highest PE was 15.9. And the lowest PE is 6.3. So we didn't even get up to the 20 or anywhere close to that. What else do we care about? Everything else is just in the range of whatever we were looking at. On the price to cash flow, we were looking for 20 or less there, and nothing even got above 10. So the highest was 8.4. And what kind of companies were in here? Well, I am looking for stocks that Buffett would buy, and there are numerous in here that he would buy, although there's one airline, and we know what he thinks about the airlines after getting burned in the past. Although Berkshire Hathaway has owned airlines, and they owned them 5 years ago when the pandemic hit. But that was the lieutenants who bought those, and then he ordered them to sell them. And they haven't gone back in. So I don't believe he would buy the airlines. But everything else is just kind of your standard cheap company in an area that we can easily figure out. Like General Motors is on this list. It is one of the 2 Zach's number 1 ranked stocks, but I did not pick it for today's podcast. We've talked about GM many times. I feel like it has just shown up on a lot of my screens for years now, because it has been a cheap stock this whole time. But now it also has the nice Zach's rank to go along with it. So that's good to see. But I did pick out 3 other companies. And so we're going to dive right in on what these are. And some of them may surprise you. I tried to pick ones we haven't really talked about maybe ever, or certainly in a long time. So there are some newer names on here. And some of them have interesting charts. So let's do it. Okay, the first one is APTV, ticker AP, P as in Paul, T as in Tom, V as in Victor, APTV. And just looking at it on Zacks.com, we have it as a vehicle component manufacturer with 140 manufacturing facilities and 11 technical centers in 49 countries. Then I go on their website and they describe themselves as a global tech company. So I'm liking that already. They're trying to pivot a little bit away from the auto side. And they did just recently issue a press release saying that they're joining with Robust AI to co-develop an AI-powered collaborative robot. So that's also interesting. In the third quarter, their revenue was up 7% to $5.2 billion, and they raised full year 2025 guidance. So that's where we're getting some good Zacks rankiness. You would think with the higher ranks, we would get companies that, we are seeing the analysts raising. And even with APTV, which is a Zacks number 2, they have a market cap of 17.6 billion. So a large cap company, not a mega cap, but large. This one, again, they did beat and raised. So for 2025, earnings expected to be up 23.2%. That's nice. And then 2026 coming back down a little bit, up just 7% right now. Sales up 3.4% next year. Forward PE is 10.6, so that's cheap. PEG 0.8. Of course, it's cheap. That's what we screen for. But that's we're getting the value and the growth. And then price to sales ratio, we already know is under 1 because that's what we search for, but it's 0.87 and a price to book of 1.86. So everything is looking real good. The A for the value score, because they all have A's. They are doing share repurchasing, and they did pay down debt. They're having an investor day on November 18th. So if you're listening to this before November 18th, you can tune in there. They are separating their electrical distribution systems business. So I wait to see what they say about that. So tune into the investor day. We're starting to see a little bit of a transformation with these types of companies that do have the ability to pivot from, say, autos to maybe the robotaxi or, robots, these kinds of things. And these companies aren't waiting around. They are doing it. Year to date, shares are up 38%. Yet it still remains cheap because 5 years, it's down 24%. But we have seen it come off the lows. The lows were around Liberation Day. Those were the 5-year lows, and now it is off of there. So this stock was mostly left for dead. It is in the auto area. And its industry is automotive original equipment, and that has been out of favor. That's why it got so cheap. But it is trading around the 52-week high now and still is cheap, really cheap. So you might want to keep this one on your list. APTV, ticker APTV. This is the type of company that Buffett normally likes, and we are getting some nice earnings growth expected. So that's also good. Doesn't say we have a dividend. They're just doing share repurchases. But I also like it that they're paying down that debt. So all good things. APTV, APTV. Okay, the second company is Mistras Group. This is definitely a Buffett type of company where you're not really sure, you've never heard of what they do, but Berkshire Hathaway owns several companies like this. So it is a leading one-source multinational provider of integrated technology-enabled asset protection solutions, helping to maximize the safety and operational uptime for civilization's most critical industrial and civil assets. That's a lot, right? But they're in oil and gas, aerospace and defense, power and utilities, ding, ding, manufacturing and civil infrastructure. Now, I was looking for the other than power, I was looking for the other magic words, data center, and they are not yet in there. Infrastructure includes bridges, dams, and buildings, but they are definitely open to getting some opportunities in the data center side. They are specialized in an engineering firm with pipeline inspections. They have a proprietary management software suite. They have 120 offices worldwide. So this is right up their alley with the AI build out. And the stock is kind of reflecting that now. So year to date, up 48.8%. 5 years, it's now up 200%, but it's been a rocky road. Hasn't been all straight up and to the right like a lot of the AI stocks. This is a small cap company, 410 million. So Buffett can't really buy it now, but he could have 50 years ago for his portfolio for Berkshire. But these small caps, it's just too difficult now for Berkshire to buy them. It doesn't really move the needle, but it's not too difficult for us. And 2025 earnings expected to be up 13.9% and another 19.5% in 2026. Now, the key for these engineering companies is not necessarily revenue growth, but gross margin expansion. And they did expand margins 300 basis points in the quarter. It was 29.8% up from 26.8. That's where you're going to get the earnings growth. But this is the only downer. It does expect flat revenue growth for this full year, even though revenue was up 7% in the third quarter. So it is exiting some unprofitable business this year, and then we'll see what happens for next year. This is the one with the highest forward PE of 15.9. And the PEG is just barely there at 0.99. We looked at 1 and under, remember, but it does qualify, so we'll take it. We only have one analyst estimate on it, so that's going to make the earnings a little more volatile. But that estimate is higher in the last week, and we're now looking for 82 cents versus 67 cents just the week before for this year, and then 98 cents for next year. That's also much higher. Was looking for 81 cents and now is at 98. So they must have said something good on their earnings call, and maybe they used the data center words on the earnings call. Not sure, but these kind of engineering firms are very in demand right now, and that's going to help with gross margins, because everybody is throwing money at all of these firms to get the infrastructure built out, and so they can charge more. One of the engineering firms, not Mistras, but one of the other ones, said that they could almost charge whatever they wanted on some of these projects. So we're not quite there yet, maybe with Mistras, but this is still a cheap stock, and it's Zacks number 2 right now. It's got A for value, as we know, B for growth, C for momentum, and A overall. And the category therein is electronics-miscellaneous products. It is a top 15% because a lot of these electronics categories in the industries are secretly AI stocks now. And so the earnings estimates are on the rise with these companies. So that's Mistras Group, ticker MG, M as in Mary, G as in George. Okay, then we're going to move on to the third company. And I have talked about this company in the past, but it's been a while. I used to own it in the value investor portfolio here at Zacks. We did sell it a couple of years ago when the Fed started tightening rates, because it's Miller-Knoll, ticker M as in Mary, L as in Larry, K, N as in Nancy, MLKN. And this one is furniture, both residential, but also office furniture. They own 15 brands now, and they are a combination with Knoll, Herman Miller and Knoll combining, but they do own Knoll. They own the Herman Miller brand. They own Hay. They own Design Within Reach, which is a retail store, and they now operate about 80 plus retail stores globally, and they're opening up 1 or 2 every quarter, it seems. So depending on the brand, they just opened up a Herman Miller store in Chicago. So they're not all Design Within Reach stores. They do run retail stores with several of their brands. But retail in this last quarter, it was their fiscal Q1 2026. Retail side was up 8%. Orders were up 8%. So that's good to see. On the rest of the business, they did see orders fall overall 5.4%, while net sales were up 10.9%. But the orders were falling because of the pull through from the fourth quarter, especially in North American contract. That's the commercial side, the office furniture side. And why would that be? Well, the tariffs, right? People are trying to get their furniture in as fast as they can and their orders in so they can try to avoid some of those tariff impacts. Companies not avoiding it completely. Adjusted gross margins in the Q1 were at 38.5%, down from 39.2 in Q4 and 39% last year. And then in their guidance for the second quarter for gross margins, they gave 37.6 to 38.6. But you can see it's kind of going in the wrong way, probably due to, just again, the impacts of the tariffs and just the costs issues. Free cash flow, 2025, it was 102 million. 2024 was their big year in free cash flow, 274 million. 2023 was at 80 million. 2022, when the Fed raised rates and everything tightened, nobody was buying furniture, even for the office. It was a decline of 107 million. So we'll keep an eye on the free cash flows with MillerKnoll. They do a dividend and do share repurchases, and they're very shareholder friendly and give back most of the cash. They obviously have some CapEx spending as well, but right now they're paying a dividend of 75 cents. And because the shares have fallen to what looks like 5-year lows now, the yield is 5.3%. So that's a big yield. I always warn people to kind of keep an eye on that dividend, whether or not that's sustainable, but their free cash flow appears to be pretty decent right now, once again. So it's not all terrible. 2026, but though earnings expected to decline 4.1% this year, and then rebound in 2027, up 30%. But it's coming off of last year where the earnings also declined 6.2. So it's been a struggle for MillerKnoll. It is among the cheapest stocks on the screen. Forward P is just 7.6. PEG ratio is 0.6. So these are all dirt cheap. And now the stock finally has broken down. It kind of wasn't able to do so. And by breaking down, I mean going under $15 a share. Year to date, now down 35%. And again, it's just basically right there at its 5-year lows. So I really feel like on some of these furniture stocks or housing in general, that they kind of have to have a washout, and then I will be interested because they're just going to get too cheap. And why would this be a Berkshire Hathaway stock? Well, Buffett really likes companies that have name brand recognition. So Berkshire Hathaway owns Dairy Queen, for instance, and the See's candies. Those are really well-known brands. And again, they've been around a long time. They've survived the competition. That means they have some kind of moat. MillerKnoll has also been around a long time. Herman Miller, for decades, and even Design Within Reach for decades as well, and some of these other brands like Knoll as well. So they do have strong branding, which Buffett really likes. It does have competition with Steelcase and others on the office furniture side, but a couple of these companies have pretty much have the market to themselves now. And on the retail furniture side, it has quite a bit of competition with the RHs and Ethan Allens of the world. But they do have a nice little niche in that luxury area, which is what Design Within Reach is in. And also, they take a lot of great pride in their design capabilities. And so they really appeal to those that are looking for that certain design aesthetic that is like Hay or Herman Miller. So what do I think about this one? Well, there is Zacks number 2, and you might be thinking, well, everything sounds so grim. Like their gross margins are declining, earnings are expected to be down, but how did it get to number 2? Well, we do have one estimate in the last 60 days that's higher for this year and next year. But and the estimate has trickled up a few pennies. So we're looking for $1.87 this year. That's up from $1.81. We're looking for $2.44 next year, up from $2.42. And remember that dividend is 75 cents, I think I said. And so we're looking for $1.87 this year. They made $1.95 last year. They did pay that dividend last year. And sales expected to be up 3% this year and 4.5% next year. But we really kind of need a turnaround in housing to get the retail side really going, even though North American region orders were up 8% in this first quarter, but some of that was probably pulled forward as well. So yeah, Miller Knoll, I still call it Herman Miller. Miller Knoll is interesting. It is already pretty dirt cheap, but I fear it hasn't really been washed out yet. And so I would probably be on the sidelines on this one, hoping to get it even cheaper. I'm not sure if we're going to get it much cheaper, but that would be the hope with this one. But you are getting that dividend to give you some, to reward you for your patience, as I like to say. So that's Miller Knoll, ticker MLKN. So it's an interesting group, right? Two have seen big surges in their stock this year. One has not. They're all dirt cheap. They all are Zacks number 2 ranks, and they all have value scores of A. So look around out there, run these screens. There are Buffett-like stocks out there. I also ran a couple of other screens for this podcast, including like large cap value stocks. And I ran the Buffett screen that's on the Zacks ZRS system. We never get many stocks with that screen, and I only got 2 this time, and they were both foreign stocks, which fits the bill too, because Buffett has been buying the Japanese conglomerates in recent years, and he has never, shied away from buying foreign companies, especially if they're dirt cheap. He bought a bunch of Korean companies a number of years ago that were big winners for him. Those Japanese conglomerates are big winners as well. He got those really cheap. So the key with buying Buffett-like stocks really isn't to let down your standards. You can find at least 9 stocks that have very low classic value fundamentals and are Zacks number 1s and number 2s with the value style scores of A and B. So you're not getting the huge list and you're not getting NVIDIA, but you can find these companies out there. And as value investors, we like to dig around and find stocks that nobody else is really in or talking about. And I have a feeling these 3 stocks are in that group. So we had APTV, ticker APTV. We had Mistras Group, ticker MG. And that could be an AI play. Well, actually, the first 2 are likely AI plays. They're even mentioning AI. And Mistras is mentioning the data centers in their presentation. So, and then we finished with the furniture company, Miller Knoll, ticker MLKN. That's the only one I would probably be on the sidelines still, but I have a history with it in the value investor, and it hasn't been real pleasant history in the last couple of years. So I might be tainted a bit. And maybe I need to look at it with some fresh eyes and listen to those conference calls. But I do encourage you to try to do a deep dive on these companies, find out what is going on. I just did a cursory one looking at the last earnings report. I did not listen to the conference calls with these. So if you do that, you're going to find out even more information. I'm sure they're being asked about the AI and the data centers and power generation and all of that. So get in there, find out what you need, and use these screens to kind of narrow down the list That's what we like to do. So, as always, I'm bringing you value stocks every week, and I have been for 9 years, 8 years, somewhere along those lines. And we will continue even when Buffett is no longer leading Berkshire Hathaway. Hopefully, we have several more years of his Thanksgiving letters. I encourage you all to check out his letter. It's his usual folksy wisdom just about life and investing, what he's doing with his Berkshire shares. His children are all older and basically at retirement age now. So his fears of leaving them with, all this money for their foundations and whatnot when they weren't prepared have now been abated. But we can always learn from the world's greatest investor, and he does urge people to think that there's more to life than just accumulating either stocks or money. And so I end this episode with that thought, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.